Hello there. Welcome to Financial Accounting N5. We're still working on a question paper of November 2022. So this question paper that we have today again, we are going to look at the last question on that question paper, that is question 6. So with that question paper, this is our question 6, and the question reads, the following information was obtained on 30 August from the financial records of information retailers for the previous 2 years. So we are given the information that we have there on the list of balances, whereby we've got a column for 2019 and also have a column for 2020. So what does it mean? It means the current year is 2020, and this one becomes the previous year. 2019 is the previous year. And then this information that we have, then we also have included in the above the following. So we have got this information of data control and trading inventory for the 2 periods again. Uh, so what it means is the data control, remember, is the current asset, and then we've got trading inventory also is the current asset. It means these figures, as for example, for 2019, 180,000 and 90,000 are inside current asset figure for 312,000. So they are part of the current assets. Uh, so that is what we have. And also for 2020, the same applies. 250,000, 120 are inside the 540 there for the figure for current asset. So this is what we have. Then we also have additional information from other information that we are having here. And then the information that we are having is from A to C. Uh, that is our A, we've got the business maintains a profit markup of 30%. Then second one, B, trade receivables get 30 days credit, and the business is allowed 60 days credit from its trade payables. Lastly, we've got good inventory turnover rate for similar interests in South Africa is 4 times per year. Then we have the first part of question 6, which is 6.1. It reads, choose the correct answers using the financial information for goodness to the retailers for the year ended on 30 August 2020. So very important. Uh, uh, the instruction is specifying that we should confine ourselves to the information for the year ended 30 August 2020, which means for the current year, this is the information that we are going to use for the calculations that are going to follow. So in the matter that maybe we might need to refer to the previous year, according to the formulas or the calculations, we can then refer. But we are concentrating on 2020. So this is what we have. Then on the first part of the question, that is 6.1.1, it reads cash sales amounted to. So the question is only asking about cash sales, and this cash sales, remember, for 2020, for the period of 2020. So we can go up there and try to see how can we calculate cash sales. Uh, then the sales information is here. Sales 20% cash in brackets. So we are given for 2019 in the first column, and then second column is 1,352,000. So, but we are told 20% is the one that is cash. So we can just say 12% of 1,352,000 to get the amount that is needed to be entered there. So basically, we are saying 20% is 20 of 100, and we multiply by 1,352,000. But basically, this 20%, which is 20 over 100, can reduce it to a decimal and it becomes 0.2. And then we multiply by 1,352,000. Then let's try to see the answer that we get there. Let's try to calculate correctly. That's 0.2. Then we multiply by 1,352,000. Then the answer that we get there is 270,400. 270,400. So here we've got 270,400. So this is the figure for cash sales. So we can go down and check all the answers that we have if we have got that figure. So we'll see that B is the correct answer that we are having there. So we are here, B is the correct answer. Then we move on to the next question. The next question reads, a cash problem can arise when this is a cash problem. A cash problem, which means we've got low levels of cash in the business. So we are facing some problems. So that is the explanation that is needed there. So if you go through the answers, you will see that A is the most appropriate there, which reads trade receivables pay too late. So trade receivables, remember, they are those customers that we are selling goods to on credit. So if they pay late, it means you're going to receive the money late. And during the period that we don't have the money, they haven't paid, we are going to face some problems and it becomes cash problem. Then we have some responses that are going to follow. It says that inventory turnover rate increase. When it increases, it means we are not going to have cash problems. We are actually going to have cash in the business, because when we have a turnover, it means the high turnover means we are selling at a faster rate, so we receive cash each time and again. So this is what we have. Then C is the business pays its trade payables too early. So, it means the cash is going out early. So uh, uh, this is not directly affecting our cash flow problem. The same as D, we are seeing that it's not affecting again the cash flow problem. So the only appropriate response that we have there is A. See that the business pays its trade payables too late. The business pays its trade payables too late. This does not lead to a cash flow problem. Actually, we are holding cash for a longer period again. Uh, we are holding cash for a longer period, but this is also on the other hand, it's also not a good position, because when we pay too late, we might attract some interests, and it might be a problem again. But it's not directly linking ourselves to the cash flow problem. Then the same as C. So A is the most appropriate there. So we can indicate our A as the most appropriate. Then I will go to the next question and see what we have. Right on 6.1.3. 6.1.3, it reads, the firm at a rate of inventory turnover of 9 times per year. This shows that it's we are seeing that the responses that we are having are relating themselves to the businesses in South Africa, or all responses. So we'd like to go back and see what is the average inventory turnover of businesses in South Africa that we are given here. We are told that this firm has got 9 times. So we go back to check the average of the business in South Africa in the question. So you see that we are given here, or see good inventory turnover rate for similar industries in South Africa is 4 times per year. Good inventory turnover rate for similar industries in South Africa is 4 times per year. So this one is 4 times. So we are comparing it with this one of the firm which has 9 times. So the question is, which one is better between the two? Let's look at A. Let's look at A. A is the same as the similar business in South Africa. This is not correct, because the similar business in South Africa are giving us a rate of turnover of 4. So they are not the same. Then B is worse than similar business in South Africa. It's not worse, because when we have got a higher rate of inventory turnover, it means we are selling our goods at a higher rate. And when we are selling at a higher rate, goods are coming in and going out at a faster rate, and we are receiving cash time and again. So it's not a bad position, it's a good position. So it cannot be a worse position. It can only be a better position. So you see that C is the most appropriate, is better than similar businesses in South Africa. So we have got C there being the correct response. Then we go to the next one, 6.1.4. It reads the current ratio should be at least, right? This is a norm that we should know, that the current ratio should be at least 2:1, should be at least 2:1. So 2:1 becomes the most appropriate. We have got the current ratio, and also we have got the acid test ratio. The acid test, both of them, they are liquidity ratios. So you'd see that the acid test ratio, it should be at least 1.5:1. Then the current ratio 2:1. So this one is the current ratio. This one is the acid test ratio. Acid ratio. So it should be at least. So we can just put in some arrows there to show that this should be a greater or equal to this one, greater or equal to this one. So this is what we have in terms of current ratio and liquidity and the acid test ratio. Then the next one is 6.1.5. So let's see what we have. our 6.1.5 reads the amount of cash and cash equivalents is equal to cash and cash equivalents is equal to, right? Cash and cash equivalents, we can go back there to see what we have. But cash and cash equivalents is in current assets. So it's inside the figure that we are having for current assets. Remember, we are using the figures for the current year according to the instruction of the question. So current assets for the current year, we've got 540,000. So we have got 540,000 there. So we can just say 540,000. Right. But we are told that there at the just beneath that we are told that included in the above we have put these current assets also. So we've got 250,000 inside 540,000. We also have trading inventory of 120,000 inside 540,000. So the remainder becomes cash and cash equivalent. So what we are going to do, we are going to subtract these figures from this total for current assets. Then we get the figure for cash and cash equivalents. So we are saying minus 250,000. Then we subtract again 120,000. Then the answer that we get there becomes the figure for cash and cash equivalent. So we can just try to calculate there. We put 540, 540, and then we subtract 250, then we subtract again 120. Then we get 170,000. So the answer that we are getting there is 170,000. So this is to be the figure for cash and cash equivalents. So we can go there to check what we have in terms of the responses. So 170,000, we see that it's on C. So I would see that C is the most appropriate that we have there. So this marks the end of the multiple choice section. So we can go and look at what we have beneath that. So on 6.2, we have got calculate the following ratios and percentages of Nkume Zulu retailers for the year 2020. 6.2.1, rate of return on owner's equity. Rate of return on owner's equity. So what we are going to do, we are going to put the formula first, then we just substitute the figures that we are given in the question. So this is the rate of return on of owner's equity. Rate of return of owner's equity. So it can come here. This is now 6.2.1. This is rate of return of owner's equity. So this ratio, the formula now to calculate this ratio, we say net profit. Net profit. Then we divide by average capital. Average capital, then we multiply by 100 over 1. Then we multiply by 100 over 1. So we are just going to the information that we are given in the question. When you look for the figure for net profit, then we calculate the figure also for average capital. So let's go back and see what we have. So net profits, we are having the figure there. Let's see that we are here. Net profit is here. We are using the current year, which is 98,600. We are here. 98,600. So this is the figure for net profit. The average capital. So for average capital, we are saying we are going to add the total for capital for the current year, which is 360 a year. We are here. 360,000, then we add to 350,000, then the total we divide by 2 to get the average. Then this is the figure that we are going to use then. So we can just present it there by saying this one over this one plus this one divided by 2. So we can just go there and just substitute those figures. So we are now here, we are saying the figure that we got for the net profit is 98,600. Then for average capital, remember we are saying the capital for the current year plus capital for the previous year divided by 2. So we are saying 351,000. 351,000. Then we add 342,000. Then the total that we get there, we are going to divide by 2. Divide by 2. So we just do as such, and then we calculate that We calculate that there we are going to get 28.46%. Rounded off to 2 decimal places, you get 28.46. So this one is 2 decimal places. So this is what we have in terms of this 6.2.1. Then we can check what we have in terms of the next question. The next question is turnover rate of inventory, turnover rate of inventory. So we can go there. Remember, we want to put the formula down first. This is 6.2.2, 6.2.2, and this is the inventory turnover rate. Inventory turnover rate. So the calculation, the formula is equal to cost of sales. We divide by average stock. Divide by average stock. So we are going to look for those figures again in the question. Cost of sales and for average stock also we look for the figures, but for average obviously we are calculating, we are adding and then divide to get the average. Right. For cost of sales, let's try to see. We have a figure for cost of sales. We're seeing we do not have a figure for cost of sales, but we can be able to find that figure. Remember, we can say the formula that we have is the sales minus cost of sales is equals to our gross profit. So we can just make cost of sales the sum of the formula there so that we find it, because we've got the figure for sales here, and we also have the figure for our gross profit here. So we can find our cost of sales. So making cost of sales the sum of the formula there, it becomes cost of sales is equals to sales minus gross profit. So we can just substitute there for our sales for the current year. We've got 1,352,000. Then we subtract our gross profit for the current year, which is 360,000. Then we calculate that one. Let's try to see what we have there. 1,352,000. 1,352 minus 360. We are going to get 992. 992,000. So this is what we have for our cost of sales. So the average stock, remember we are saying a cost of sales of average stock. Average stock now, we are here. This is the stock that we have, and we have got stock for these 2 periods, current and the previous. So we want the average. So we are adding this one plus this one, then we divide by 2. So for average stock, now, now we are on average stock. We are just adding 120,000, and then we add our 90 divided by 2. So let's try to see what we have there. Average stock. We are going to get 105,000. So this is how we are going to just present it there. So we can just go there on our answer section. Right. So we are now saying cost of sales. Our cost of sales, we found 992. We can maybe try to show how did you arrive at 992,000. So you can just maybe present it in the form that we say here. You say cost of sales. Cost of sales. Find cost of sales. We said 1,352,000. Then we subtracted 360,000, and we got 992,000. So this is what we have in terms of cost of sales. And then you go again and show the calculation of average stock. Average stock. On average stock, we are saying 90,000. We added 120,000. The total divided by 2, and we got 105,000. So this is what we have. Then we can just substitute now. There, remember the formula is now cost of sales over average stock. So our cost of sales is 992. This is now the rate of inventory turnover rate. This is now the inventory turnover rate. Inventory turnover rate is equal to, we are saying 992,000. We divide by 105,000. The answer that you are supposed to get should be in the form of times. So it's 9.45 times. So this is the answer. So we should know that our inventory turnover rate is presented. The answer is presented in the form of times. So this is what we have on that one. Then we go to 6.2.3 is the next question. 6.2.3, and we go check what we have in terms of that one. We have got current ratio. Current ratio. So we are saying current ratio. So on the current ratio, remember the formula for current ratio. We say current assets. Current assets is to current liabilities. So you take the total figures, total current assets and total current liability, right? And then the answer you are supposed to present it in the form of the side of the current asset should be left as 1. Here should be 1. 1, then S2. The figure, it depends on the figure that we are having here now. So what it means is the figure that we have for current liabilities, we divide it both sides so that this side becomes 1. So this is what we have. There, this is the presentation of the current ratio. And the same to the asset test ratio or the quick ratio. So we go there to check the figures that we have in terms of current assets and current liabilities. So we are here. You see that the figure for current assets is we have got 540 for the current day, 540,000. Then current liabilities, we have got 310,000. So we can just go there and present it in that form. So we are saying current assets, remember we are saying it's 540,000. As to our current liabilities, we are saying 310,000. So for us to leave this side as 1, we divide by 310,000 both sides. So if you divide correctly there, this one becomes 1 because you say 310,000 into 310,000, you get 1. So this side becomes 1. And then another side to 2 decimal places is to 1.74. So this is our current ratio. This is our current ratio. Then obviously we are now on 6.2.4, which is the last one. 6.2.4. So we can just go there to check what we have. 6.2.4 is the solvency ratio. And the solvency ratio, we say total assets as to total liabilities. So this is the presentation of the solvency ratio. Right, so we can go there to check what we have in terms of total assets. So to get our total assets, we are going to say our current assets plus our non-current assets. So here, current assets, we've got 540 for the current day plus 120 for non-current assets. Then we get our total assets. Total liabilities, we are saying we add our current liabilities plus non-current liabilities. So current liabilities of 310,000, non-current we put 50,000. So we add the 2, then we get the total. So you can just go there and do that in the answer section. Remember, we are saying this is the solvency ratio, and the formula is total assets is to total liabilities. So on total assets, remember, on total assets, we are adding the two. We can just maybe try to add them that side, then we just bring the totals here. We are saying 540. We add 540 for current assets, then non-current assets 120. If we add the two, we are going to get 660. 600 total. This is our total assets, 660. Then our total liabilities, we are adding 310 plus we get 360. So this is 660 S2 360. So you can just go there. And present it like that. So we are saying 660 S2 360. And again, this one, this side divided by 360. So that this one becomes a 1. And then also this side divided by 360. Then if you do that to two decimal places, it becomes 1.83 S2 1. So this is what we have in terms of solvency ratio. And this is the last part of our question. Thank you for listening. Those who haven't subscribed, please subscribe and share. We are still coming as we prepare for exams. For this video, I'm signing out.